Hi, Larry Gaines, PowerCircleTrading.com. In this video, I want to show you one of my favorite option strategies. This is what we call the calendar diagonal spread. So basically, it's a strategy where you're taking advantage of time decay, and it gives you that option on your strategy, this structure, to buy options at a discount. So let's see how this works. So the basics of the calendar diagonal is you're capturing time decay, okay? Like say a covered call, you have stocks that you're long and you sell calls against it to collect time decay. So you're getting time decay without completely sacrificing direction. All right, so it's a really great way to get into a directional trade and discount those long dated options. So you're going to be benefiting from the rate of time decay between your long option, longer dated option expires further out in time than your short dated option that you're short is going to be closer into time. So with time decay, if you're closer to expiration, that's going to decay a lot faster than if you're further out. So you go further out on the long option, closer in the short option to take advantage of that. So you get the advantage of that time decay plus correct speculation of price direction, plus if there's a positive implied volatility skew, meaning that the front short expiration date option has a higher implied volatility than the back. So those are some really great benefits for this structure. So the calendar diagonal is a really great strategy when you're wanting to take advantage of, say, short-term weakness or strength that you think will eventually in time revert back or cycle back up to, the call side if it's call-based, or puts if it's put-based. So for example, if you think you've got a stock or something that's going to eventually go up, but you think it's going to take some time to consolidate, kind of feel back and forth, you sell that short dated against your long dated, you're taking advantage of that kind of that churn where you're getting the premium decay, and then that can offset and discount the long dated. So it basically is a strategy that's both risk controlled on the short dated side and that can become open ended on the long dated side if it goes according to your directional plan. So similar to a covered call, if the short dated option of your calendar diagonal spread expires worthless, that really kind of then becomes what I call the free money, and that's buying or reducing that long dated option. So just like a covered call, you have your stocks that you're long, you sell a call against it, and if that call doesn't get called out, you keep the premium and you can amortize down the shares. But instead of buying expensive shares here, you're buying a long dated option. So the underlying security though, if it moves in the direction of your long dated, eventually this can really become a powerful way to play an upside or downside move. So the fact that the calendar diagonal has two different strike prices and two different expiration months is really what makes it unique. So what it does in general is it attempts to capture premium decay while you're waiting for that direction to kick in, and that's what I call the morphing into either a long, if you're long a call, or you can do it with puts for a downside move. And so if your directional forecast goes right, this can turn into a really powerful winner. So by having that short dated option side expire worthless and the long dated option side explode in value, you've got some very big potential for big profits. So here's an example on Walmart. So I've been watching Walmart here. You can see it's had this big sell-off, all right? So it's starting to get that rounded bottom here. Now I've been looking at this for about a week and looking for it to eventually directionally move up. Now I didn't know it's going to have this big move today, so we were going to look at doing this as a calendar diagonal, all right? So it'd give this time in case it backs and fills and holds this and consolidates and then moves higher. Now the basis is that directionally we think it will go higher, but we want to be in a trade where we can sit on it, for a while in case it just turns sideways and get paid while we wait. So kind of like a covered call, we get paid while we wait, but instead of being long the shares, we're going to be long a longer dated option. So let's take a look. So in this example, Walmart was trading about, right 140.80 or right thereabouts. So went out to the 6 November series, okay, and bought the $140 strike call. That was at that point in time was going for $550. All right, so bought that, and then at the same time turned around and sold the 9 October 145 call at 75 cents. So if you look at that, your cost of your debit side is $550 minus your credit you received. So this trade is $475 is your cost of the spread. So the max risk is the debit paid. So like a covered call, instead of though buying the shares, 100 shares at $140, you're buying the option contract. So your basic trade is $475 is your maximum risk. Now, if this was to go to, let's say it goes to 145 on Friday, which I doubt it will, then it would be up $116. And so you could take it off for that, which is kind of an income trade. Or if you think it's going to close below the 145 on Friday, you could just let that expire worthless, keep the $75. That's going to adjust down that cost of your $550 long dated option there, reduce that cost, and then you can just let that run as a long option position or roll to the next month. So that's the beauty of it. So let me show you the series so you can kind of get a feel for the time involved, timing of it. So in this example, you're long the 6 November, the 140 call, okay? So you have 37 days until that comes up for expiration, and then you shorted the 9 October right here, 145. So that's a shorter duration option, so it's going to decay, have the implied volatility, have the theta decay much faster. here. So that's what you're taking advantage of it. So here's one more example. We did another one on Microsoft that's turned out really well. So this was set up a calendar diagonal on the 25th right here. So we were looking for Microsoft at that point in time. We were looking for it to move higher, but we thought it could kind of maybe stall out right up here to this 50 simple moving average, which was coming in at 210. So instead of just going long calls or whatever in case it backed up here, came up here and fell back down, we did a calendar diagonal to take advantage of theta decay if we had to wait it out. So here's what we did on this trade and where it stands today. So on the 25th of September, we went out to the 16 October series and bought the 205 call. Went long that cost $6.75 or $675 for one option contract versus buying 100 shares at 205, and then immediately sold the 2 October, which expires Friday, the 210 call against it. So $5 wide spread at $1.80. So this sets the spread up at a cost of $4.95 or $495 per one spread. And you can see today it's currently up $122, trading at 210. Now, if on Friday this was to trade and close below 210, the option that we have is to let this expire worthless. We keep the $180. That will reduce the cost of this long-dated 205 call down by that amount of credit. And then we could decide to just let it run if we want to the upside just based on the long calls, or roll and sell the 16 October against it. So it gives you a lot of different things that you can do with the strategy, and it's one of my favorites. So if you'd like to learn more about this, make sure to visit us at powercycletrading.com. Use the link on this email, and I hope to see you soon. Good luck trading.